Okay, so let's now move on to financial covenants. These are a particularly important area now with the pandemic, and so we'll spend a couple of moments just looking through this area. What I'm interested in, first of all, does anyone kind of have an idea? What's a general description? What do we mean by financial covenants?
I suppose it's the measures the lenders take to protect their lending, like the banks,
Yeah,
etc.
so they're agreements or conditions that banks can put into their loan agreements, and it provides them with some kinds of protection, hopefully, on their lending. Let's have a look in a little bit more detail. And while I'm doing that, I'd be interested for you to think about whether you can think of any examples of covenants that you might have seen. So, financial covenants, as we've said, we've seen significant impact from the pandemic. These are undertakings by borrowers to maintain relationships between numbers in the financial statements. And it's this idea that basically they are trying to minimize or at least stabilize their risk by tying financial performance to the lending that they've made to the organization. Now, we won't see it in every lending agreement. Some borrowing is made without any kind of restrictive covenants in the contractual agreements, but it's rare, particularly for small organizations where there's a power distance, I guess, between the bank that really has the power in the relationship and the organization that needs the borrowing. They're negotiated, they're very precise. We need to read them and understand them very carefully if there are covenants in the financial statements. It is the responsibility of the borrowing organization to comply with the covenants, to test that they're in compliance on a regular basis. Again, this will usually be agreed in the lending agreement. And it may be that these have to be tested annually, so generally when the financial statements are produced, or half yearly, again, usually when the annual financial statements and the half year, the interim financial statements are prepared. But it can even be more restrictive than that. There can be a 4-quarter rolling arrangement or almost a continuous monitoring going on. But what's key is it is the borrower's responsibility to test and issue a compliance certificate to the bank to say they are in compliance. What they're designed to do is to protect the lender against unexpected changes in risk exposure from the borrower. They are designed to kind of minimize the chance that the borrower won't be able to pay back. They can be an early warning of risks increasing. And generally what happens is if you breach one of these covenants, the bank is entitled to demand full repayment immediately. Now, they often don't. In fact, they usually don't. But what it actually does is it triggers an opportunity to renegotiate with the bank. So before we kind of look at these in more detail, I'm interested to know, has anyone thought or can tell me of any examples of the kinds of terms that might be included in a financial covenant?
Yeah, one type would be maintaining a certain minimum ratio of assets to liabilities.
Yeah, that's exactly right, Tim. So quite often what we see are balance sheet based ratios, and these are about the sort of absolute amount of debt to the assets. And so often we see things like a 2-to-1 ratio. For every dollar of debt, you must have at least $2 of assets. And so these are very firmly based in the balance sheet. Can anyone else think of any other examples they might have seen? Debs, I know when we were talking earlier, you had an example.
Yeah, so you're often required to maintain some kind of profit level, whether it be an amount or a ratio or some kind of guaranteed level you're not going to drop below.
Yeah, so there's this, instead of focusing on the balance sheet, sometimes these will focus on the income statement. And often these are about a relationship between the amount of interest you have to pay and the amount of earnings or profit or some metric like earnings before interest, tax, depreciation, amortization, EBITDA, that has to, again, maintain a certain relationship. So, you know, and there's other kinds. They can be quite exotic kind of complex covenants, because basically they're anything that the bank wants to put in there and that you are willing to agree to. But at the end of the day, they're there for the bank to try and protect itself against the possibility of default. Like we said, if you do breach one of these covenants, generally what happens is that you are required to pay the amount back, or at least the right of the lender is that they can demand repayment immediately. And as we said, these are often tied to the end of year financial statements. And so what we want to look at is what happens if you breach one of these covenants right at the end of the financial year. And before we look at it, I'm actually interested to see kind of what you think might happen. So we have a question here. At report date, 30th of June, an entity identifies that it is in breach of a leverage covenant in long-term loan agreement. The lender is entitled to demand immediate repayment at the 30th of June. But as usually happens, what actually happens is that we enter into a negotiation period with the lender. And on the 10th of July, the lender agrees to waive that covenant. And so my question for you, and I'll pull up the poll now, is what or how is this going to be accounted for in the financial statements? Okay, hopefully there you can see the poll. Give you a few moments to have a look over and see what you think. All right, one person has put their money down. 2 of you, great. 4, 5, and we have everyone. Thank you very much. That was very quick. That's excellent. All right, so let's have a look at what we've got. So as you can see, 4 of you have said we should classify the loan as a current liability at the 30th of June and disclose the waiver as a non-adjusting event. Now, that is the correct answer in this case, in accordance with the International Accounting Standards Board. This is always sort of been the case, but they really tightened this up a couple of years ago and made it really, really clear, explicitly clear, that where you've breached a loan covenant, even if you very quickly, subsequent to report date, renegotiate that agreement at the 30th of June, your report date, you were in default, and that's what you have to report, and therefore it has to be current. But I have quite a bit of sympathy. The alternative view, one, is quite often a position we used to take in the old days, and in fact is still the position under US GAAP. According to US GAAP, if you renegotiate, you can continue to report as though you had never been in breach. So that answer would be correct under US GAAP and was kind of an answer that we might have got occasionally under old IFRS. But now going forward, the expectation is that if you're in breach at the 30th of June, that's what you report. All right. Let me just stop that and clear that. Okay. So one of the questions I've got for you is kind of, why do we think that coronavirus is more likely to, or the circumstances around coronavirus are more likely to lead to breaches of financial covenants? What sort of things is COVID-19 doing that leads us to be worried about breaches? Any ideas?
Reduced earnings?
Yeah, absolutely, Donna. This idea that lots of companies, particularly hospitalities, property companies who are renegotiating leases, they are reducing their income, and so they're at risk of breaching those profit and loss, income to times interest kind of covenants. Anyone else? Debs, I see you've got your hand up there. Did you have something for me?
No, I didn't actually.
It's a bit like an auction. You got to be careful. Your hand is up and you're bidding, as far as I'm concerned. But anyway, you got an idea for me?
Well, yeah. Asset values can be lower or dropping, or nothing's stable at the moment.
Yeah, so all that stuff we were talking about yesterday with the issues around impairment. Obviously, if we're impairing assets, our assets are getting lower in the balance sheet. And if we've got balance sheet-based covenants, assets to liabilities, there's going to be a real risk that we're going to be in breach of those covenant agreements. So absolutely something we have to watch out for. So as you can see, you know, if we've got to know what covenants we have in place, and we have to really think about whether, you know, reduced earnings, as you said, earnings before interest and tax, increased financing costs and increased borrowings go hand in hand. Lots of organizations at the moment have had to increase their borrowings to cover cash flow to get through this difficult time, and that can increase the amount of interest they pay, or it can increase the sort of gross amount of borrowings in their balance sheet, and both of these could breach various covenants. And as we said, reduced asset values. But if there is a breach of a covenant, that's a default. And as we said, that means that often the agreement says you will need to, in theory, pay back the loan immediately. And as we said, this isn't usually what happens. Usually what happens is the bank enters into a period of renegotiation to try and protect itself from the increased risk of losing that money. And because of that reason, you know, it is an important area for us to monitor. Usually when the bank enters into that negotiation period, there is going to be a cost for the company. It might be increased interest rates to cover the increased risk. There may be some fees associated with the default. Quite often the bank will try and find ways to improve the position of the company. So it might say, look, you've got to go out and raise equity to increase the cash holdings in the organization and to protect us a little bit from the risk of default. Now, as we said, from an accounting perspective, if a breach occurs on or before the reporting date, if by reporting date there's no agreement in place where that covenant breach has been remedied, you will need to report that as a current liability. Even if almost immediately after report date, you reach an agreement with the bank. It's what was the situation at the 30th of June or at report date that is going to be very important. If you do find the situation that you're in breach at the report date, but soon afterwards, you actually do negotiate a waiver or a change to that agreement, then you report that agreement as a non-adjusting event. You disclose it in your financial statements, but your actual debt is still classified as a current debt. If the breach occurs after report date, at the 30th of June, it was a non-current liability. And again, we have this non-adjusting event. Subsequent to report date, we actually have breached our covenant, and therefore the debt now is classified as a current liability. Two things that come out of this. One, if you think your organization is at risk of breaching those covenants, it's probably better to talk to the lender sooner than the end of the financial year and try and get that negotiation going before you actually trigger the covenant. That way you can continue to report the liability as non-current. If you do trigger one of these covenants, then you really do need to look at the going concern status. If the bank was to demand payment in full, could we actually cover that, or would that be the end of the organization? So the final thing I just want to look at before we finish up this section is a real life example. So this is from the financial statements of Capital and Counties Properties Proprietary Limited Company. We've been looking at their interim report. You can remember yesterday we were looking at some of their going concern disclosures. And if you remember, they are effectively the landlord for Covent Garden. So in the center of London, we have that wonderful old sort of marketplace, and they're responsible. And you can imagine, if you think about the impact COVID has had, we've had a reduction in tourism. We've obviously had issues about traders who may not be able to pay their rent at the time. And this has had a significant impact on Capital and Counties. So we can see here from their financial statements, the Covent Garden debt facilities have two principal financial covenants. Now, again, think about what we were talking about earlier on, the kinds of covenants you can have. One of them is a loan to value ratio of up to 60%. And so what we're basically talking about here is a balance sheet type covenant. That's the assets to liabilities kind of covenant. We also have an interest cover of at least 120%. This is an income statement based covenant. So based on earnings of some measure to interest. Based on the forecast net debt position, the valuation of the property portfolio would need to fall by a further 40% during the period under consideration for a breach to occur. So what they're basically saying is when it comes to the balance sheet, we're okay. We have enough assets that they'd have to fall by another 40% for us to be in breach. Just let me get this going. So stop that. There we go. Due to the anticipated impact on net rental income of COVID-19, a waiver of the interest cover covenant has been agreed. So this is the opposite. They actually have a concern here. The interest coverage waiver does not look like it was going to be met. So they have actually gone and agreed with lenders in relation to the period up to and including the 31st of December 2020. So they have renegotiated this waiver ahead of time up to that 31st of December. During the remainder of the going concern period, and remember we talked about that yesterday, this idea that the going concern period is looking into the future for about 12 to 18 months, the interest cover covenant is not expected to be breached. So what they're telling us here is they actually think incomes will increase come early 2021 and they'll be fine. However, headroom is limited in a downside scenario in the absence of mitigating actions. So if things don't improve in January, they are saying they have concerns. They will have to renegotiate this waiver and in fact may have to renegotiate it even more. Given the current uncertainties created by COVID-19, the group will monitor the interest cover position closely, taking mitigating actions within its control, and if required, will seek interest cover covenant waivers in relation to future periods. So it is a serious issue. It's affecting lots of organizations, and we certainly need to be monitoring any covenants that we have in our financial statements. All right, so that's it for this section. I think that's a good place for us to take a break. And when we come back, we're going to start looking at some of the direct effects that COVID-19 has had on leases.